Our business actually is, when I quit HUL, I quit with the understanding of 15 years that, there is 6% for a distributor, 12% for a retailer, and 2.5 to 3% at the minimum of logistics, which is a cost that a consumer goods company incurs to reach out to the shelves. Okay. So if you just total this up, we are talking about 23, 24 odd percent, and we are now talking scale of Unilever. So if you look at a youngish FMCG company, the expense could be much higher because they don't get synergies of scale. They have to pump in higher margins into the retail outlets. They also spend a lot more to acquire distributors for themselves. Now, if a quarter of sales of a consumer goods company is actually getting lost in the value chain from its factory to the shelf, I think that's a lot of money that's going waste. And how do you come to the subjective comment of lot of money? Because if you go back and look at the balance sheet of listed consumer goods companies today, I think most of these companies operate at a 15% to 20% EBITDA, right? Now, if you're spending 24, 25% on actually non-value adding parts of your supply chain, my philosophy is there's a lot of flap there to be cut. In fact, I would reckon that this could actually come down to about 15% in the next 5 to 10 years, right? And the balance 10% is what companies like us would like to take some share of and also give some share back to the consumer goods companies so that there is a win-win. So that's really our model here, right? So there is a 10% efficiency loss that happens in the value chain of a $300 billion industry simply because it's not optimized for supply chain, it's not optimized for inventory, it's not optimized for working capital, right? So people are over-inventorized, under-inventorized, there's a lot of back and forth that happens, there is freshness which becomes an issue on the food supply chain. So there are so many complexities and it's so under-technology driven that 10% of sales is actually a sitting duck. It'll take a while, like I said, 5 to 10 years to realize that. But then the pie is very large, right? So 10% of a $300 billion industry tells you you're talking 30 billion as money to be taken away, right? Now that's not a small industry, and it's an industry that grows, right? It grows at 8 to 10% year on year. We've never had a year where consumer goods have declined, right? So either they premiumize, right? So you have a lot of cosmetics and premiumization of the portfolio that happens when the economy is doing well, when the per capita is going up. When the per capita goes down, then a lot of consumption of low value items goes up, right? So either which ways, this industry always grows. So it's a fantastic industry to get into, fantastic market size, a very large problem, very well-established problem, and a problem that all players want solved. The distributors do not want to be distributors. Consumer goods companies don't want to deal with 3,000 distributors. Retailers want credit and they want in-time inventory. They don't want to be ordering only once a week. They want to order at the time that they want something. They want to order in the quantity that they think they can sell in 2-3 days. So they want to under-inventorize, reduce their working capital. And none of this is happening in the current market structure. This is what we are actually trying to solve here, right? So our competitors are distributors, so we want to replace them, right? I was talking to somebody who's looking at an equity investment in the company, and they said, do you compete with Reliance or Amazon, or do you compete with distributors? So I said, because we compete with distributors, I think it's a trick question. So you should be very clear. These guys have just gotten started, right? In fact, Amazon distribution is one of our key customers. So they collaborate with us. They don't compete with us. So we are the only front-end partners in Bangalore for Amazon distribution. Front-end partner means we manage the customers, we manage the supply chain, we manage the warehouse, and we earn a percentage GMV cut in terms of a business model. In parallel, we run our own large business called Taiki, which does about 100 crores GMV on a monthly basis, but off late because of some working capital issues, and that's why we're talking to you here. We've dropped on sales, and with this infusion, we're looking to go back up. Our idea is to get to about 100 crores in the next 3 months or so on a monthly basis as GMV. we yesterday signed up another 5 crores of working capital, which was not in your note because the note went out before this got done. And we did not want to write work in progress on your note because that is misleading for investors, right? So there is a firm that we've signed up with who's extending a 5 crore working capital line to us in Bangalore starting Tuesday. Then we've also got a confirmation from a few HNIs in Bombay who are syndicating to invest 50 lakhs in the company. That also happened last evening. So both these will come in the course of next week. Plus there is a term sheet from Ugro, which is on channel financing. I don't know whether that got a mention in your note or not, but that's also come. Yeah, so we have about 8 to 10 crores of capital now in play on the working capital side. And interesting thing, Nikhil, is that this ultimately is a negative working capital business. It's just that you have to scale it using capital, but once you've scaled it to 80, 100 crores, you can start returning the working capital back. And you can actually use Nikhil's money to pay Vivek and Vivek's money to pay Sachin, and then the go-round starts, right? And if you have a clever finance team, which we have, you're able to slowly start reducing working capital and become profitable, right? So our business model on the B2B side, which is our flagship business called Taiki is nothing but goddess of prosperity. So our value prop to the customer is that we deliver prosperity to your doorstep, prosperity in the form of grocery, right? So like any other e-commerce product, they look at the app, order on the app, that order goes to our fulfillment center, which is a warehouse. Our smallest warehouse is 3,000 square feet. We pay about $20 to $30 per square feet, depending on which place we are in. From there, the orders are picked and packed. What we sell is oil, staples, consumer goods, cosmetics, pens, stationery. What we don't sell is fruit and vegetable, dairy products, anything that requires cold chain like ice cream. We don't sell all that, right? So we are also very clear on what we will sell and what we will not sell. We don't like quick perishables because your write-offs can be higher, right? And the market is so large that we don't want to play the difficult bets just yet. In the peak, we were serving 30,000 orders on a month. So we have the capability. Our tech is in-house. The order is then delivered. We accept payment via UPI, cash, RTGS, NEFT. So within 4 days, we're able to turn around our capital. Our objective is to make 8 rotations of capital in a month. And every rotation has to deliver a contribution margin for us, which helps us recover cost of capital and our indirects. So at the current level, we're almost breaking even at the contribution margin level. And indirects get covered by, if you look at the Amazon business, there is something called AWS, which Amazon has, which is a very profitable golden goose that supported its B2C arm for a long time. We have something called 1SF, which is a technology product for Salesforce management. HUL is one of our largest customers. It's a 10-year-old customer. It's a SaaS business. It's tech and services combination. It helps them get most out of their salespeople. So that business collects about 80 lakhs a month as SaaS revenue with almost an 85% contribution margin, right? That business is not just 10 years old, but is also scaling up, right? So we are looking to add another 6 to 7 lakhs of revenue just from that. So we want 1SF to cover our indirects, and we want Taiki to be unleashed at contribution margin break-even level and become a 100 crore, 150 crore business by the end of June, okay? By the end of June, the company is looking to raise a $30 to $50 million private equity round with EBITDA positive as a company with an outlook to become a $2 to $3 billion GMV player at 2% net margin of sales as EBITDA by the end of 24 calendar year. Ambition, I spent my time 15 years with HUL, a listed company, top of the line talent, top of the line ethics, and commitment to the country. My ambition is to take this company public by the end of 23. So we are 2 to 3 years away from there. So I'm very hopeful that with the current round that we are closing on working capital and the next equity round, which is going to be the last round of capital the company raises, we should be able to take this company public. So that's really our story. Got a bunch of passionate leaders in the company. Some of them are on the call right now. Corona, I hate to say it, it's a problem for the entire human race, but professionally speaking, it is not a problem for us. It only accelerates our sales because distributors pack up. They're not able to cope up with the environment uncertainty, like getting passes for essential services, or also being able to retain their workforce and be able to offer them, like our entire workforce switches to a PPE, they get a hygiene allowance for sanitization and so on. I mean, things which a responsible employer will do, which a distributor is not able to, so they lose talent, they lose their markets. Last round, because there was a proper shutdown, some retail stores never opened back up, so they lost a lot of capital which they had given out as credit. We don't. We don't offer credit on our books at all, but we are working with NBFCs so that they can offer credit. But this is not the time to be offering credit to retailers, right? It's an unpredictable, unreliable segment. So we will come to credit in good days. To summarize our value proposition, which is what we are looking to get from you, is to be able to scale fast, which means we need more warehouses, which means there is more capex. We want to lease that capex back to Grip Finance and become a strategic partner for Grip, so that whenever we open a warehouse, there is Grip which is taking on the capex on its books, and we get the racks and shelving equipment. Our key customer on this side is only Amazon. Otherwise, we deal directly with suppliers like Unilever, ITC, Procter & Gamble, Reckitt, and so on. Our value prop is to serve 1 million Indian customers, which is corner stores or grocery stores or kirana stores, with a very wide assortment of consumer goods, priced competitively, available promptly, and with a facility to pay later, which is the part on credit. So we are there, we're walking towards that journey, and that is the journey which we want to one day list in the Indian Stock Exchange.
Okay.
So that's
Awesome.
about us.
Yeah.